Great job, and we kind of put together hastily like we always do, only because there's changes that we occasionally have to do, and I'm pretty sure that I'm actually confident that they're going to do a great job at presenting a good overview of their industry. So let's start like we normally do. We're going to go down the line and we're going to have each one of the affiliates introduce themselves and tell us how long they've been in the business without having to reveal too much age. Let me get you the other microphone. You want to start, Letitia? Sure.
Hi, my name is Letitia Pumice. I've been in Temple City with Allstate Insurance since 1986.
Good morning, Sam Ming from Farmers Insurance, 21 years. My office is now Hambron. Thank you.
Hi, good morning. Sam Lamb with State Farm. Before I joined State Farm last December, I was a financial planner with Wells Fargo Private Wealth Management for 8 years. Started ever since I was in college, and I work with my beautiful wife, Nicole Lamb.
Good morning, everybody. Marco with Allstate. 26 years. Used to live just 2 blocks from here, so.
Great. Hold on to the microphone. We're going to start right away with one of the first questions. This is going to be directed to Mark. Mark, are there differences in dwelling coverage? If I receive proposals from different companies all showing the same dwelling limits, how should one compare one from each other? Should they use premiums alone, or what should they do to compare coverage?
You know, this is a really important question, and I just tried to simplify it for you guys because oftentimes, you know, you're dealing with reputable companies up here, but sometimes you just get policies and you don't know apples from oranges, and oftentimes a client or a consumer will just go and they'll look at that price and they'll go, man, everybody's giving $400,000, so let's see, the premium's $800, but we're getting $400 on every policy, so let's just go with that policy. And so they'll pick that policy, and let's just for right now say it's the Fair Plan policy from the California Fair Plan. Well, what tends to happen is you might not realize this, but all those policies are different and they cover different amounts of dwelling in the event of a replacement. So the next slide will kind of reveal to you. So here's what happens though. With the premiums, if you happen to have a claim for $555,000, then depending on which company you're dealing with, the bottom lines of the maximum amount of policies these companies will cover is going to be, you know, a different amount. For instance, you know, company A covers a maximum of $600,000, but the company CFP does $400,000. And the issue with that is if you had a loss with company CFP, then there would be approximately $155,000 that you'd have to pull out of your pocket. So you don't want to be put in that position. So the easiest way, without knowing all these dollar amounts, is if you get a proposal from any company, whether it's A, B, C, D, E, F, G, ask them what is the maximum amount of coverage your policy will pay in the event of a loss. That will help you evaluate a little bit better. And then you want to also ask, what kind of endorsements? Does this policy have replacement costs versus actual cash value? Meaning, you know, will they depreciate if there's a loss? Or will they give you whatever it costs to rebuild up to the policy limits? Another thing you want to make sure is there building code upgrades? For instance, if you lose a house here in San Gabriel, and if the house burns down, you know, all companies say that they'll rebuild according to like material, like quality. But if the city of San Gabriel makes a code change, whether it be on electrical or on window upgrades, or they want, you know, something different, they don't want wood shake roofs anymore, they want a different type of roof, that creates extra costs. So if there's building code upgrades on the policy, then that will be paid for.
Okay, the next question goes to Letitia. Letitia, what is liability insurance as it relates to auto, property, and personal umbrella policy?
Okay, first of all, liability is protecting you if somehow you are at fault for and injured somebody. So let's look at the different products. Let's say you're driving in your car and you were in a car accident, and the other person got hurt. It was your fault. Let's say you rear-ended them. So they broke an arm, they broke a leg, something, they're out of work. So the liability insurance of your car insurance will cover that injury. It'll pay on your behalf. And that's why the law requires you to have at least liability insurance. So when you just say, oh, just give me the lowest price, give me the lowest coverage, is that really the right thing for you? You have to sit down with your insurance agent and ask them for advice, ask them for suggestions, because maybe you're a property owner, maybe you have a good job, maybe you have other rentals and so forth, and you don't want to just have $15,000 of coverage, because if they sue you for more, it comes out of your own pocket. So that's one thing. In property, if you own your home and you, let's say, have a gathering and somebody comes over and got hurt, whether it's a dog bite, whether it's in your pool, or they just tripped or something, they're going to sue you. Where does that liability come from? Well, if you just said, I just want a fair plan, California Fair Plan, that doesn't have liability in it. So you're out of luck. It'll come out of your own pocket. So what is the best thing to do? Talk to your agent, ask for recommendations. Maybe $300,000 is not enough of liability insurance for you. Maybe you need more. So that's where an umbrella comes in. That's an excess amount over and above the coverage that you have on your car, or your house, or your boat, or all those things that we own sometimes. So that's one thing. A condominium, for example. Sometimes you just say, oh, good price, pretty low, I'll pay for it cash. Nobody's telling me to get insurance on it, really, not even fire insurance, not even liability or anything. So since there's no bank and nobody bugging me, I'll just go without insurance. Anyway, I pay HOA fees, right? Well, guess what? If somebody came to that place, whether it was a rental or your own place, and got hurt, and they sue you, the liability in your condominium insurance, if you bought it, will protect you. If you didn't buy it, you're out of luck again. So please sit down, get advice from your insurance agent. That's the very most important thing to do. Don't go for price alone. Thank you.
Okay, this message is over to Sam Lamb. Speaking of liability, what's the means or what's the process quickly that you would determine the liability amount that you use?
Definitely, quickly. All right, so if I can just have you guys take one thing away from today, I want you guys to be curious. And be curious every single time that you're talking about insurance. Insurance is not just insurance on just your personal assets, your life. It's risk management. And one of the ways that incorporates that into risk management is determining what your liability limits are. So for me, someone that comes from a financial planning standpoint, we really want to focus on a macro standpoint and say basically where that comes from is that you need to know exactly what your liability limits are and how that incorporates into your net worth. Because if you do not have the property liability limits, that uncovers vulnerabilities not only to you, but your net worth, not only to your 401ks or your SEP IRAs, but also to your future income. So one of the things that you need to do is when you're talking to your insurance representative is you need to come from a financial planning standpoint and saying, how do I determine what my liability limits are? And that insurance representative should sit down with you and do a total asset collection to get you a better idea of what your net worth is. That number that you get from doing that asset gathering is going to be able to help you determine what your liability limits are. That is the most important number that can start with insurance because that's where we uncover the vulnerabilities. That's how we determine exactly what those liability limits are to make sure that you're properly covered.
Perfect, thank you. Sam Eng, could you tell us, is earthquake coverage already included in my homeowner insurance policy?
Well, most of the homeowner insurance, they do not cover earthquake coverage. You actually need a separate earthquake policy to cover the earthquake damage. Now, I'm just curious, among us here, who actually have an earthquake policy here by showing your hands and let me see?
An upgrade policy.
You have a home, then do you have an earthquake
I
policy?
thought it was upgrade, but it's earthquake policy.
How about the panel? Do you carry it?
Yeah, I carry it, and, well, it's not a lot of us that carry the earthquake policy. Actually, this question comes to me almost every day from my clients, and they were asking me whether they should buy earthquake insurance policy. Then I guess it is actually not an insurance question. I look at it. It's more like Sam was saying that it's more of a financial planning question. It's a risk management, because you need to know is if there is an earthquake strikes here, now like say 7.1 whatever and higher, a severe one, would you have enough money or funds available to rebuild and repair your house? Now, I look at it, there's maybe 3 options here. One is if there is an earthquake strike and then your house damage, it may say cost $100,000 to $200,000 to repair and rebuild your house. You either use your own savings, money I save for my retirement, to rebuild or repair, or you can of course borrow against your second loan or line of credit and get money from the bank, but eventually you have to repay them. So it's actually your money. In the long run, it's your money. So first option, second option is also your money. Third option is, say I don't have that much money, I may need a earthquake policy to cover me. So in case something happens, your financial picture actually will not change. So think about it, okay. Do you, can you afford to lose your home equity by just not rebuilding or repairing your house though?
Great answer. Back to Mark. Mark, most cash buyers do not concern themselves with obtaining insurance. Why is it important for me to, as a real estate professional, to recommend that they do so and to determine that I did?
First of all, you want to protect your own E&O and also your, you don't want to get into litigation. Oftentimes I hear this constantly where you have a cash buyer, they can close in, what's the quickest close you guys ever had? 7 days? So you're closing, let's just say we have a cash buyer here, we're closing in 7 days, and you as a real estate professional says, you know what, there's times of essence, let's just get it done, we can get the insurance later. That one statement can put you in a litigation position, and it's extremely important for you and for your broker that you stay out of this process. Because what tends to happen is, what if the property closed and then the very next day there was a destruction of the property? That cash buyer enjoyed that you got them that home in 7 days, but they will come after you with vengeance if you cost them money. So if you remember those trees falling down back in a year and a half ago in January, I recall there was a house that closed escrow, and the next day, a tree came through the house. Hundreds of thousands of dollars, all right? What they're gonna do is they're gonna put you on the stand and say, you know what, as my real estate professional, they said I didn't have to worry about it and get the insurance later. So that's one situation. Another situation is liability exposure. What if the house closed and now there's a slip and fall? Letitia talked about liability exposure. We're all talking about how do we protect ourselves. And that's probably your biggest concern as a homeowner, is that somebody gets injured on the property. So maybe they can be a cash buyer to buy that house, but what if somebody gets really injured on that property, they come after them? If it costs them hundreds of thousands of dollars, those clients aren't going to appreciate. So always protect yourself by recommending it, and if your clients choose not to get it, hey, document that statement, and then you're absolved of any liability.
Letitia, earlier you were talking about condo insurance policy. What does a condo insurance policy, HO/6, I believe it is,
Right.
really cover?
Okay. What an HO6 covers mostly is following the rules of the CCNRs. You've heard of that term before? They're the bylaws or the rules that the homeowner association has put together. And so we follow those rules. So if in the rules it says that the insurance policy, HO6, condominium, covers the interior walls, we will cover the interior walls. Mostly what the customer is saying, I need to close escrow, they're asking me for this, just what is the lowest price? Again, not just that, we have to look and evaluate, okay, you own things in there, right? You live in there, so how much do you have in belongings? Let's cover those things too. So condominium owners will cover your belongings also. Now, when you hear of the HOA fees, you're paying for the common area, the driving into your place, for those people that might have a pool or something else out there. So there's something that HO6 covers also that you could increase and upgrade called loss assessments. So if you are paying your HOA fees and you do have that master policy insurance for all the units, well, after they sue somebody might have slipped or fall or something in a common area. After they're done paying with a master policy, there might be that little overage that all the individual condo owners might have to pay, and they are assessed for that difference. The HO6 will also help you with that typically, okay? Of course, liability is also included and theft. So there's a lot of things that are covered in that little HO6 policy that some people say, I don't need. So it's very important. If it's a rental condo, same thing, you need it for the liability exposure. So you're saying, well, I don't even live there and that's not, I'm not required. Well, you really should evaluate that, because if your tenant somehow gets hurt, they will come after you, for sure. So that's it.
Thank you. Sam Lamb, what is the difference between term and permanent life insurance?
Thank you, Marcus. So really, this is one of our favorite things to really touch on as insurance and financial representatives, because this is where we can really tailor this product to our clients and allows us to have the opportunity to really get to know them. Some of the things that we would suggest is to really become educated on term and permanent insurance, and the way that you can do that is basically sitting down with your insurance representative and just simply creating a T-chart and putting term on the left side and permanent on the right side, and sitting down with your insurance representative and going through the benefits of each one. When you have that diagram in front of you, there's going to be a lot of questions that come up and a lot of what-if scenarios, because right now we're basically insuring the intangible, and that's your life. We're not insuring brick and mortar, we're not insuring steel and oil. This is an intangible, it's your life, and so it's different. And the differences that you can start with in term is that it's temporary, and that it's for a duration. And those durations can range from anywhere from 5, 10, 15, 20, and 30-year term policies. After those term policies expire, then so does the policy, and so does the death benefit. One other thing to really understand too is that it tends to be at a lower cost than permanent insurance, and you're going to find out why once we get to the permanent side. It also has the option to be convertible. Now, when I say convertible, just a quick example, you have the ability to convert all of it or a portion of your term coverage to a permanent policy. And in some cases, if you do it within a certain amount of time, you're credited the premiums to your new permanent policies that you've paid in the past 12 months to your term policy. So those are some really strong advantages. And then once again, the combination between term and permanent, the similarity is that they both carry a tax-free death benefit. Now, on to perm, which to me is extremely important, and it really can suit each and every one of you. Permanent is permanent. It's forever. It does not have a short duration. It stays with you for the rest of your life. And at the time that you actually get it, you, in regards to the rating that you get for underwriting, you keep that rating throughout the your entire life. So it has a level premium, so it's not going to increase for you. Also, there's living benefits, which is extremely important. You have the ability to build cash from the premium payments that you make. This cash is very important because it can help you along the lines of retirement planning, and also you can take a loan against it tax-free when you need it. Also, it has the ability for the tax-free death benefit as well. You can also change your designated beneficiaries as well. So this is kind of where I want you to kind of get the picture of just exactly how it can be tailored to you. But it really just takes you guys, being, like I said, being curious, sitting down with the insurance representative, asking the questions, And also, you do have the ability to have a combo term and perm. You don't just have to have one or the other, you can combine it. And the term can be for a certain part, and permanent can be for another part.
And with our final question, Sam, could you tell us, please, water damage is covered in most policies. Do people need to get flood policies, or what other perils should they get coverage for? Okay.
On the home policy, they don't cover flood damage, but they do cover water damage, of course. Mark was mentioning something about California Fair Plan. California Fair Plan do not cover water damage, so they only cover fire damage. Okay. Now, if there's a rainfall, storm, whatever, your roof come off, and then rain come through your house, your homeowner insurance should cover everything inside your house, the content and the roof. But if you look out the windows and you see the riverbank overflow, you need a boat to get you from point A to point B, then it's not homeowner insurance anymore. You need a flood insurance to cover you on that. To me, most of the flood insurance which I do is actually order from the bank, the mortgage lender, or the bank, the lender, and they look at your application for loan, and I think they do a elevation certificate, and then they find out that your house is in a high flood zone area, then they will require you to carry that flood insurance to borrow the loan. Okay. However, I look at is if my house is situated in a hillside, then I will consider purchasing a flood insurance, because after a rainstorm, there may be mud flow or mudslide that come into my house, and my homeowner insurance will not cover that, and flood insurance will cover that.
Now I'm going to open up questions to the general public, but here I need to give some very, very specific some information, some very specific guidelines. The panelists will not be able to answer questions that have to deal with past claims. So if it's a claims question, that you can take up with them individually, and you can take it up also with your insurance broker. Also, there's no questions that should be posed to the panelists where they're going to have to mention anything about pricing or about the individual company pricing, anything that has to do with, we're going to keep it at that.